Chapter 9, we're making progress in the course. So we're going to look at current and long-term liabilities. Current liabilities, anything due less than 1 year or the operating cycle. Speak briefly to the operating cycle. The operating cycle could be longer than a year for companies like Boeing or Lockheed Martin. You know, those planes are really big and really complicated. And if I'm flying in one of them, don't get in a hurry later. If I'm flying in one of the ones that are being made now, don't get in a hurry. Take your time. I don't want to crash. So it's okay. But all jokes aside, they could take longer than a year. Their operating cycle could be longer than a year. So then the definition of current would be different. But for most companies, it's due within 1 year. And then opposite of that would be long-term, and that is longer than a year. I'm going to move over uncertainties for this moment. We're going to go to exercise 9-1. One of the most concerning terms for accounting principle students often is notes payable because it can mean both current and long-term. With that one size fits everything, it is often difficult to comprehend this concept. And I like this example, and I want to cover it now to get this out of the way so you'll be comfortable with the term notes payable going forward. Notes payable can be due 13 to 24 months. It could be longer, and it can be less. So notes payable, it doesn't matter the name then, does it? It matters more how much longer is it until the due date. So in this case, it's due 13 to 24 months, making that long term because it's over a year. And the second example is due within 6 to 12 months, making it short term. So notes payable for 1 is long term. Notes payable for 2 is current. And then just to make sure you got it, so it's just 5 years from now. BAM is longer than 24 months. Number 3 is 5 years. What is it? Long term. And just one more time, current portion of notes payable. I know it says long-term debt, but let's say notes payable is long-term. What's the current portion do? It's not like a lump sum payment due. We're making payments on it, long-term debt. Usually if we're making payments, we call it long-term debt. All right, so we're making payments on it and the current portion. And let's say we're making $100 a month for 12 months. That's $1,200. So what is this current portion of the long-term debt? Current liability. Notes payable, again, let's just make sure we got it right. It's due within 120 days. That's short term. Payable, 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 payable. Payable, 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 payable. Always short term, always short term. Them's the rules. Sales accounts receivable, not a liability. That is actually a short-term asset. So 7, accounts receivable, not a liability. And the answers are there, as you can tell. Moving on, some journal entries. So to record a liability, debit cash, credit to liability. We've been doing this almost since the beginning of the course. So how do we get this short-term portion of current or long-term debt? What you'll do, and let's say with that $1,200 example, you figured out $1,200 of the payments you're going to make in the next 12 months, the next year, short term, and this is all you do. You literally move $1,200. Now I'm assuming no interest in here. I'm keeping it very simple. By doing the $1,200, it would be a little more complicated than that. However, we're looking at principal only, not interest, so this is actually pretty close to what the numbers would be, assuming that the $1,200 is principal only. Anyway, so long-term notes payable, $1,200, credit, $1,200. Okay? And then when paid, we debit notes payable and we credit cash. Let's look at an example. I think this is where we need to be. Examples are better. So mirror company borrow better for learning, in my opinion. We can talk about terms and definitions all day until we start crunching the actual problems. I think it's better to do that so you solidify your learning experience. All right, so $160,000 cash is borrowed by signing 90-day 8% note payable. Now, again, that's note payable, so it's short term because it's 90 days. This could have been $160,000 due in 15 months. And that would be long term. Usually your single payment just do once, you pay once, go 90, 120 days, whatever, and then you pay everything just in one payment. A lot of times like that I've seen in my lifetime, business world lifetime, or short term. But you could have a long term, note payables long term, so don't forget, with a face value of $160,000. Now we got to record the interest expense on December 31st. So just as a review, let's look at a timeline again. So the notes payable is taken out on November 7th. We know we got to have a cutoff for our interest expense as the end of the year on December 31st. And February 5th is the due date for the 90-day note. All right, so how many days is expired between November 7th and December 31st? Well, 30 days in November minus the 7th day, the day it was taken out, is 23. Then 31 days for December is 54. So there's 54 days between November 7th and December 31st. Well, it's an 8% loan. I'm going to direct your attention here. It's an 8% loan times 160,000 times 54 over 360. When you do that, you'll get a 1920. 1920 is the interest expense. So debit interest expense, credit interest payable, both for 1920, okay? Now, on February 5th, we're going to pay off the loan. Now, we've accrued 1920 in interest. So how much interest expense do we have between December 31st and February 5th? Well, if we had not had an end of the year adjusted entry, we would have done this for the entire 90 days. 8% times 160, you see they're the same. The only difference in this calculation is we're doing 90 for the 90 days of the note, is because it's a 90-day note, divided by 360, we get 3,200. So all you to do is just take the 3,200, subtract 1920, and that means 1,280 is interest expense between December 31st and February 5th. So the journal entry is debit interest expense, 1,280, debit interest payable, 1920, paying this off. And then we want to pay off, record the payment of notes payable, 160. And as you can tell, in this example, we have debited both payables because we're paying back the money we owe. An interesting note, this does add up to be $3,200. So the total of the debits is the $3,200 we calculated here plus the 160. So it should add up to be $163,200, and it does. And that is the cash it takes to pay off this loan on February 5th. Now, I want you need to know this entry for your exam. All right, I'm going to end the video here, and we will pick up with exercise 9-5 in the next video.